You think you know candlestick charts? Most traders only ever use one type, and that's based on time. Every candle prints after a set time interval. 15 minutes, 1 hour, daily, weekly, what have you. But being in the trenches of price action every day, I like analyzing price through multiple lenses to take advantage of information traders don't see. What if I told you there are other ways to view price action that can filter out noise, spot hidden trends, and snipe better entries? In this short video, I'll be briefly going over tick, volume, range, and reversal charts. Now, one trait these non-time-based charts all share in common across the board is reducing noise. Time-based charts will always print candlesticks just from the mere passage of time. With tick, volume, range, and reversal charts, conditions that are not time dependent have to be met before a candlestick can close and a new one opens. First up, tick charts. Tick chart candlesticks print based on the number of ticks you specify for your chart. One tick in the sense of a tick chart is one trade. So if we're looking at a 500 tick chart, this will print one candlestick for every 500 trades. One trade is one transaction that gets executed on the bid or ask, regardless of the number of shares if we're talking stocks, and regardless of the number of contracts if we're talking futures. During extended trading hours in the stock market or Asia and London sessions and futures, the tick chart tends to produce less candlesticks, making it the least noisy of all the charts during periods of low activity. Conversely, during regular trading hours when trade activity spikes, tick charts will print more candlesticks, providing smoother market structure for entries and identifying breakouts. Next, we have volume charts, which is a close cousin to tick charts. Very similar to tick charts, but instead of trades, volume is held at a constant per candlestick. So if we're looking at a 1000 volume chart, each candlestick closes once volume hits 1000, then a new one opens. These charts are great for identifying the strength of a trend. Back-to-back wider range candlesticks displacing on these charts indicate exhaustion, signifying a lack of liquidity and two-way trade. Instead, for a strong trend, you want to see consecutive tighter range candlesticks indicating acceptance by market participants. Volume charts also tend to work best with cumulative volume delta divergences. Now let's talk about range charts. Range charts hold candlestick range to a constant. In an 8-range chart, as soon as a trade executes and fulfills the 8th range, which is the smallest increment that price can move 8 times in one direction for whatever instrument you're trading, that candlestick will close and a new one opens. Range charts are best suited for volatile conditions where big moves are hard to catch on a time-based chart. It is in these conditions range charts will produce the greatest number of candlesticks than any other chart, allowing you to capitalize on steadier entries without having to chase price while the market is running away from you. Last but not least, we have reversal charts. Reversal charts specify a minimum range in one direction price must go, and a second number that specifies the exact range price must reverse by before the current candlestick closes and a new one opens. So in a 7-4 reversal chart, price must move in one direction at least 7 increments, and then when price reverses, it has to move in the opposite direction exactly 4 increments. Once the reversal requirement of 4 is met, that's when the candlestick can close and a new one can start forming. We know price action in its purest form moves on impulse and pulls back via correction. This behavior is inherently built into reversal charts. For example, in the 7-4 reversal chart, only once the minimum impulse range of 7 and the exact correction range of 4 have been met can the candlestick close, making it extremely efficient at filtering out minor, irrelevant fluctuations better than any other chart. ICT, volume spread analysis, and traditional candlestick patterns such as but not limited to double tops, head and shoulders are all highly effective in identifying trends, reversals, and entries on reversal charts.